All right. Hey, folks. Once again, this is Jason, host of Fighting Words Financial. And today, wanted to talk a little bit about SoFi. I don't know if it's a function of the algorithm or what, but I watched a couple SoFi videos and now I'm getting bombarded with SoFi advertisement all over social media on all social media channels. And there seems to be a lot of optimism building in SoFi. So let me set the stage right now. And if you've never watched my channel before, I'd let you know that I am a longtime holder of SoFi. I have been since its IPO, which means that in 2021, late 2021, and then all through 2022, basically, SoFi has eaten my lunch along with everyone else. And as well as Tesla, but we're not talking about Tesla today. Really want to talk about SoFi and other fintechs and sort of the positive winds that are blowing their way. So, for a number of reasons that are well understood in the financial industry, economic crises aren't necessarily bad for financials. You can go back and look at a number of recessions in the past, and you'll see that during recessions, financials tend to do really well, with the exception, of course, of the recession in 2008, which was a financials centered recession. Okay. So as we take a look at SoFi, one of the big things that I heard was that search volume for SoFi products was up big. When I kind of drill down into the numbers, though, and actually look at Google Trends and SoFi searches, that is not true. At least not true to the extent that you would be led to believe. Okay, so when we take a look at just the search terms for SoFi, I guess I can imagine that there is an increase overall in searches for SoFi over this 90-day period where I have the search set. But in reality, to me, it looks a little bit flat. Maybe there is a slight uptrend in this, but to be honest with you, I'm not really seeing anything that is statistically significant. Basically, the way this works is they take the highest amount over the last 90 days or year, whatever your search parameters are set to. That is what 100 is. And this is the number where it currently is and then where it was measured. Okay. So if we just look at SoFi, it's about half the amount of its highest, which was way back on November 16th of 2022, which is just after its second quarter release date. So yes, searches are up from a low point on December 26th. There was a big spike going into December. A lot of people say that as a result of the high yield savings. I'm not really sure. SoFi Bank actually is another highly used search term. I guess I can see a moderate uptrend in this. Maybe not. That's possibly my imagination here. But once again, we see a spike here in early December. And then we see a little bit of an uptrend through then. But is it as much as the videos that are out there on YouTube suggested? I don't think so. And then SoFi HYSA, which is high yield savings account search, that doesn't show a ton of movement over the time. It's actually decreased over time. So we do know that SoFi's high yield savings account is really driving membership at this point. And let me see here if I can find this. I don't know if I save this or not, but basically, yeah, here we go. SoFi's Q3 earnings. So SoFi has acquired about $5 billion in customer deposits in less than a year after acquiring the bank charter. So a lot of people who don't really understand how banking works as opposed to the rest of the financial industry in general is that bank managers as branch managers as a major portion of their overall compensation package is assets on deposit, which is dollars on deposit at their bank branch. They are compensated based on that, and it usually is a really large part of their overall compensation package. There's usually something in there about loan originations. There's usually something in there about just opening the number of bank accounts and deepening relationships. But it's really all about increasing deposits at your particular branch because that leads to an increase in business and just about everything else. So the fact that SoFi is now custodying their own accounts, they've increased their deposit base by about $5 billion, which is going to be more than almost every single bank branch in the country, with the exception of something like Laredo National Bank, which probably has $10 billion on deposit. It's right on the border of the United States and Mexico. So maybe you understand why that is. And of course, a couple of banks in California, a couple of banks in New York, in New York State as well, also going to be over that 5 billion mark. But that would be for their total existence. Like 5 billion deposits, the $5 billion in deposits just this quarter, which was second quarter of 2022, was an 86% jump from the prior 3 months. And that may be what has really triggered what happened with Anthony Noto way back in December. Anthony Noto placed trades over a course of a couple of days for 1.13 million shares of his company. I believe it was actually a little bit more than that. And that represents over $5 million of his own money that he put into the company that he leads. Now, let's remember what kind of information he has that we don't, and what kind of information that he's allowed to disclose to the public before earnings. And there's a lot of restrictions around that. So companies can, insider trading is allowed as long as you follow the rules of insider trading, and purchases really aren't looked at really, with a really discerning eye, like disposition of stock is, like selling that stock is. And I would say that, between Anthony Noto trying to tell the market something that's happening down the road here, he can probably see in the background that there's pretty stellar deposit growth, pretty stellar member growth, and of course, cross-selling over time is going to lead to greater and greater revenue per client, right? And SoFi's revenue per client has not been bad, but it's not been terribly impressive, and it has been increasing at a steady rate over the last 3 years or so. But it's not wonderful. I'll tell you what is wonderful though. It's the cost of acquisition for SoFi. Now, I don't have the most current numbers for that. Those will be out at the end of the month. And it may be, you kind of have to do a little math here to do that. But let's talk about average organic customer acquisition cost for the financial services industry in general. It's roughly $644 for organic advertising, and roughly $1,202 per client for inorganic advertising, which is basically paid advertising. So this is one of the big reasons why in Q4 of last year, SoFi spent about $130 million on sales and marketing and brought in 520,000 new members, giving it a customer acquisition cost of $248. So, and they don't break that down between organic and inorganic, but a lot of that is going to be inorganic. If you're looking at inorganic cost, you're looking at somewhere right around 6 times less than the industry average in order to get and acquire a single customer. And then you're looking at an average of about 4x in terms of products per client. That is, they're creating sticky relationships immediately. They're able to market to clients that already have through the app and also through social media. This is a growth story, and this is something I've been saying about SoFi for a long time. A lot of the pain in SoFi stock is not because of anything that the company is doing wrong. Throughout this entire decline, SoFi has been growing and improving their bottom line numbers all along. So when we take a look at last quarter, we're looking at total lending to financial services products being about 4.6 to 1 at this point. We're also looking at for the really the first time that personal loans for SoFi have surpassed the numbers, the best numbers that SoFi ever did in student loans. It's time to start thinking of them or calling them a student loan refinancing business. What they are is a business that that basically encompasses most of areas in the financial markets at this time. They've instituted a couple of new products that are really going to increase their financial transaction fees. What I'm talking about really is options trading. That's going to get a lot bigger on their platform. They just introduced that in December. So let me see here. Don Caesar Shadem says, funny thing is I got relief from many of the bags I was holding back when I was YOLOing Wall Street Bets wannabe. I've recovered quite a bit, and I will invest that money in real companies. That's always a good thing. Like the whole idea with YOLOing some of those stocks that were from Wall Street Bets is that everyone who was in the game should have known that it was a game. The whole idea was to create a short squeeze and to profit on something that's extremely short term, and the fact that there were going to be a lot of bag holders with that. There were always going to be people who were buying at the top and getting burned. I don't play those games just because a few people at the top end up making the money. A few lucky people end up making money, and most of the rest of the people escape with losses that don't even make money back. And if you look at the numbers, and I was looking at numbers on that when they talk about how many people lost money versus how many people likely gained money during the whole AME and GameStop thing. I think that the supposition was something like almost 80% of people lost money, although I didn't really agree with their methodology and didn't feel like that was completely accurate, or there was no way to know that that was completely accurate. So yeah, that's not something I do either. I'm a buy and hold investor for the most part. Happy to answer any questions today about SoFi. And like I said, I'm optimistic, but I'm not as optimistic as a lot of the YouTubers that are out there right now making videos on SoFi. And it seems like the corner has turned in terms of at least social media sentiment on SoFi, that folks are saying buy now, which is great for the short term. But fundamentals are really going to tell when it comes to this stock. Okay. And as long as the company continues to demonstrate continued membership growth, the revenue is going to follow. And it is following quarter by quarter with this company. Even things like the moratorium on, I think that the delta, even the moratorium on student loans, originally they thought that was going to take about $100 million off of top line revenues for the year. Only $100 million on what was expected to be $1.5 billion in revenues. And the idea with that is that that I don't even believe at this point that it's going to be that $100 million in revenues. It's missing from the bottom line. I think that the company's not even going to notice the fact that student loan revenue is missing, even though at the top of the market, they did like $3 billion in student loan originations in a single quarter, and now they're down to about 400 million. That has been completely replaced by personal loans at this point. So I am a little bit concerned with the fact that they're going to have those personal loans on their books at this point. That is a higher risk portfolio. It's also a higher reward portfolio. You're going to have a greater amount of defaults in that portfolio, but you're getting quite a bit more in the way of interest. So let me answer a question here. Sean Lee says, hi, when do you think Biden will allow student loan repayment? So the statement has already been made, is that they're going to let all of the current cases kind of run their course. And if they don't, if they don't finish by June 30th, then payments are going to resume 60 days after June 30th. So somewhere around August 30th is probably when student loans are going to be resumed. And to be honest with you, I didn't expect this extension from December all the way to June. So I don't believe that there's going to be another extension when it comes to student loan repayment. If that business and forgiveness, let's remember, forgiveness is $10,000 in student loan, forgiveness for folks that don't qualify for Pell Grants, and another $10,000 for people who do qualify for Pell Grants. That's a potential of about $20,000 or so, right? That's still going to leave a lot of student loans on the table, even for people who have student loans. It's going to wipe out the complete debt for a lot of people, but it still leaves, I think there's $1.7 trillion out there in student loan debt. And that is not going to change by the biggest degree. There's still going to be plenty of opportunity out there. So let me hear. So Bram, always good to see you, Bram. Thank you for coming on as usual. Hello from snowy Canada. Man, you could not pay me enough money to get me up in Canada in the wintertime. Be glad to go in the summertime. I'd love to see more parts of the country than I have. But dude, I am not about snow, not at all. Anush Gupta says, hi, Jason. What do you think about the legalization of marijuana and its effect on stocks? So right now, the United States has a problem with the legalization of marijuana and its effect on stocks, is that most companies that are dealing with marijuana are shut out of the financial system to a degree, meaning that they don't have access to credit markets in a lot of cases, because marijuana is still a Schedule I drug. So I'm hoping that we have full legalization, but I can tell you one thing, man, it's going to be a free for all. And all of the companies right now that are traded publicly are really focused on the production side, and there's nothing that's publicly traded right now that's focused on the retail side. And that's largely because of the fact that they're kind of shut out of financial markets. You essentially have to use cash or an ATM card in order to access anything from the dispensaries. I would like to see it legalized just because we do live in a democracy. Most people here either have smoked weed or do smoke weed regularly. And me living in Southern California, it's been legal here for years, and we don't have any more problems than we did before. So I'm all for legalizing it across the country, and I think that would be a better thing to do. Legalize it and tax it. California, not only that, include them in the financial system, and you'd probably see your tax revenues go up to a large degree on that. Right now, a lot of the business is being handled in cash, which means that there's a lot of opportunity not to pay taxes. There is quite a bit of auditing that goes on, meaning the people who are responsible for auditing these retail locations, they are busy, they're working every day. But man, there are dozens and dozens of illegal dispensaries who have set up shop here in San Diego, and they get busted every month. So what I see happening is once that's fully realized, is that the people who've kind of started now are going to have a massive head start once it's fully realized on everyone else kind of trying to jump into the game. And that's and that, but even so, there's going to be a massive winnowing of a lot of bad ideas. It's going to open the industry up to competition, and that's going to be a good thing for the marijuana business in the long term. But it's going to be a bad thing for a lot of the stocks that you may be invested in right now. They may not be able to compete once the field is leveled and once the field is fair, right? And the field is definitely not fair right now in terms of who's getting licenses for dispensaries, who's allowed to produce. When you look at all the people who have been thrown in prison for growing a little bit of weed in their backyard or trying to sell a little bit here and there, versus the people who are now getting into the business and making, tens of millions or billions of dollars out of there. So, yeah. So why do you think about, what about Chinese Baba and educational stocks? Thanks. So, Alibaba may or may not be a good investment, but they're such an institution in China, and they have such an not isolated, but they have a pretty good ecosystem around their suite of products that they're going to be fairly solid for years. They're investing a lot of money into research and development at this point. Now that I think that politically they're kind of back in favor at this point, now that they've kind of had a shuffle of management and priorities have gotten slapped down a couple of times. But I would not touch Chinese educational stocks with a 10-foot pole. There have been, and I've been investing in Chinese stocks for a long time, and I've gotten burned in a couple of periods where it was discovered that a lot of stocks that were traded on, U.S. That were traded on the U.S. markets were actually nothing more than frauds. And what I suspect is these educational stocks are coming next. That these are going to be the next big wave of Chinese fraudulent companies that are going to be found are going to be those educational stocks. I do not, when I read through their investor decks and I read through their financials and I take a look at the cost of labor in China rising like 14 times just in the last 10 years, or 15 years or so. I look at the fact that the Chinese population is likely shrinking, and that they're just not having children fast enough, and they're not encouraging much immigration. And I look at how their education system is focused already. It's focused on rote memorization rather than focused on getting people to think critically. And we're not doing the best job of that here, either here in the US, getting people to think critically. But it's a particularly acute in China. And there's cultural reasons. There's been a civil service exam in China, I believe, since 221 BC. That's when the first civil service exam was introduced. And that was a pathway to the middle class, a pathway to a government position where you could accept bribes. And I'm not saying that being judgmental. It is simply a different culture and a different imperial system, and then a different way the things developed to the U.S. The civil service exam was heavily focused on rote memorization because they weren't teaching critical thinking skills back in 221 BC in China, and critical thinking skills were not required. And this is a simplistic explanation for this, but and there are nuances that I'm glossing over, so don't take my word for this, like because there are tons of nuances that I'm glossing over here. But it introduced a sort of static element to the education system, and it hasn't really advanced in quite some time. So we aren't totally innocent of that either. Like our education system essentially is stuck in what in 1890 would have made someone a really good factory worker, right? It's not really setting up students to be successful in the 21st century. Really intelligent students who are, say, 1, 2 standard deviations above average intelligence, they're educating themselves on what they need in order to be successful in today's economy. But the average person, say IQ of 100 or so, um, it doesn't really have a lot of places in today's economy to figure things out and kind of make it to that middle class lifestyle. And the education system, K through 12, is not setting themselves up or setting them up to be successful either. So we need a radical overhaul of our education system as well. But in terms of these Chinese education stocks, I suspect that a fair number of them are actually going to be frauds. So, and Hiker Dave, I have not acknowledged you in quite some time, although I have seen you in the last couple of live streams too. Also, one of my longest term subscribers, as far as I know, and frequent commenters on the channel. Just wanted to recognize you here. Sean Lee again says, thanks, man. Good insights. Hoping to see SoFi get back to their hyper growth mode. So SoFi was never in a hyper growth stock mode. They went from like $10 a share at IPO up to 25, did not stay there very long, and then dropped below $15 by the end of 2021 and have declined ever since. So they've never really been a hyper growth stock, right? Their growth as a company in terms of revenue growth, member growth, product growth, basically line of business growth, that has actually always been in hyper growth mode, and that has not changed. Okay. So we are looking at fundamentals start to take over SoFi, and it's going to do that before they hit profitability. And I've seen a couple of different estimates this year on where people think SoFi is going to end up. I don't think that $10 by end of 2023 is out of the question. I really don't. I don't think I saw one outrageous video that said 129% growth over the next 3 years. Man, I'm not buying that for a second. But if we see really solid growth this year and sustained 10% growth, really solid growth, meaning 100% growth in this year, where fundamentals start to take over, they sort of edge into almost profitability by the end of 2023, beginning profitability in 2024. If we saw 100% growth this year from $5 a share to $10 a share, and then 10% a year after that, compounded, I think that's probably more realistic. And that's really good and what you should expect for the stock over time. And 10, 20 years from now, this is a long-term hold for me, but 10, 20 years from now, if this is 10% of your overall portfolio and you continue contributing to this, this is going to be a really, really good investment for you. So I'm gonna try to spin some things up here on innovative industrial properties. So I assume you're talking about innovative industrial properties here, Sean. And let me know if I have the right one. Where is this traded? Let me see. So I have no opinion on innovative industrial properties. Volume was 396 shares today, and average volume is 1,699. Whatever it closed at, this price is imaginary. There is no market in this. In this, looks like it's a REIT. Is it self? Oh no, it's a self-advised Maryland corporation focused on acquisition, ownership, and management of specialized property leased to experienced state licensed operators for medical cannabis facilities. So this company has no value, no real value. Last trade was at 28.14, but considering there were only 396 shares traded today, it's probably insiders trading stock in between themselves, trying to pump the share of the price of the stock up. This is a dividend that's probably only really being paid to insiders on there. But it has no real value if the average volume is only 1,699 shares. The market cap is 1 billion, but average volume is only 1,699 shares. I don't know. Maybe there's something about this stock that I'm missing. Maybe there's something about the stock that I don't know. Uh, but I would be surprised if this is an actual real value. Okay. And there's a lot of this that's reported, not a lot, but there are a fair number of really small companies like this that are reported like this on Yahoo that really don't have a market. And so you can be fooled into thinking that's really worth $28 a share. If you tried to sell 10,000 shares at 28.14, I don't think you can get that. I think the offers would be quite a bit lower, or that order wouldn't close by the end of the day. So you see here, Varenza or Van Raz 86 says SoFi is up 10% of my portfolio, and your average is $5.50. I'm long term at least till 2025, hoping for a 4x return. I think a 4x return would be really ambitious. 2 years away is not long term. It's still a short term investment. Like, basically, you have about a 20% chance of loss in any individual stock in any individual year. By the time you get out to 5 years, you only your chances are reduced a lot slimmer. By the time you reach 10 years, you have about a 96% chance of making money in a stock over time. Not only making money over time, but beating inflation over that time period as well. And let's remember that the most common return for a stock over a 7-year period. I'm talking about all stocks on the market, all 28,000 stocks that have been traded over the last 50 years. So the most common return over a 7-year period is actually 100% loss. All right. And a lot of folks don't realize that. Most stocks decline to zero. Okay. I'm not saying that SoFi is going to decline to zero or anything, but a 4x return by 2025, I would really love that. I would absolutely love that. But do I think that's going to happen? I do not. I think that that we're out of the sort of irrational euphoria that we had for a lot of SPAC stocks. I think this is one of the few SPAC stocks that's actually going to turn into a real going concern. 4x turn is unrealistic, I think, but I'll be happy if it does happen. So I also own Block. What is your stance on the stock? Did crypto hurt them on the short term? So I have not looked at Block for about a month and a half, really not at all since that whole FTX thing. So I don't really have a huge deal of information to pass on to you guys right now at this point. In fact, I don't even know what the price is recently. I think the last time I looked at it, it was kind of in the upper 50s. So it's up to $71 a share at this point. So it's recovered somewhat. Yeah. So it was in the 50s last time I looked at it. So, I mean, this has always been a really highly volatile stock, and they've dipped back into where they weren't profitable last quarter. Some of that, of course, had to do with crypto and sort of the money that they're spending, realigning themselves with crypto. I don't see a lot of clarity in terms of direction when it comes to Jack Dorsey. So that's one of the things that I am sort of concerned with. I do hold some Block, but like I said, I really haven't looked at it for quite some time. So Keith X, I own a large portion of VTI, which is the Vanguard Total Stock Market Index, and I own a lot of VOO, which is the S&P 500. Just because, and that, like, literally, if you can think of a boring old stock, unless I owned it prior to my switch to ETFs and mutual funds, 15, 20 years ago, I stopped trading for the most part and S&P 500 stocks, just because the S&P 500 is a buy and hold index. I am a buy and hold investor for the most part, and I want exposure to small caps, mid caps. I don't want to do all the research on small cap and mid caps. I understand the math behind which companies make all the money and which ones don't. It's a very small slice of any index. Something like 1% of the shares on the S&P 500 have accounted for more than half of the gains of the S&P 500. So, and the other half have a lot of them have declined, or at least accounted for no return in the S&P 500. So I generally tend to buy individual stocks that are not on the S&P 500, that are not on the NASDAQ. And that's where I focus my individual stock purchases. And that's where I think you have the only opportunity really to outperform the market, is by owning some of those that are not on any of those major exchanges. So yeah, let me see here. So a stock that I've talked about in the past, and this is brought to me by folks who are in my Patreon group, Big Bear AI. So I just know a couple of people that are involved with the company. This is one of the reasons I've talked about it before. It, it's really a small company right now, but it's not a they're a unicorn, meaning they had more than $1 billion in valuation without being public, but they were also a unicorn that was profitable before they went public. They went public, spent a lot of money on different things. So 2022 has been a down year in terms of up year in terms of revenue, down year in terms of earnings, but they just secured a $900 million contract. It's indefinite delivery, indefinite quantity, which is common for software contracts or for these AI contracts. Like there's not really a metric to measure how you deliver, right? So $900 million contract is going to go a long way to shoring up the revenues for quite some time. That stock is up like 250% for the day. Don't jump on it just yet. Okay. There's already been a few weird things happen with that stock. And if you look at BBAI right now, and let me be clear, I don't have any inside information on this company or anything like that. That's not the kind of conversation that I'm having. 260%, by the way. So if you look at the 52-week range and you see this $16.12 trade, that was me, folks. And so I basically have the all-time selling high for this company, and I think I bought it at something like $5 a share. And I also bought some call options on it, like at 12 or something, or 10 or something. Ended up selling everything at like $16.12 a share because the drive and the run up just didn't make any sense whatsoever. It made zero sense whatsoever, and I knew that there was a bit of market manipulation or some shenanigans going on in social media that were pumping the price up. So 111 million shares traded hands today, and on average, about 100,000 shares trade per day. This is a stock right now that you still can't say that has a generally healthy market in this. And the fact that you see this massive volume of shares trading hands, which I believe is more than all of the outstanding shares. I think there aren't 100 million shares that are out there. That's shares being changed, traded over and over and over and over. This is something that you should probably avoid right now until we have real clarity in the market as far as what's going on. Unless you want to throw a few bucks in there to gamble, you're of course you're free to do that. I can't tell you what to do, but that is something that I would avoid right now. Let me see if I missed anybody's questions here. I haven't missed anything so far. Let me see here. All right, Hal says, I have a corporate takeover happening in code SWIR finalized today. What happens in the US? Who sells the stock for you so you get paid out, assuming you don't sell it on the market? Generally, you don't have to do anything for those. You'll get issued either a replacement stock, or your brokerage company will actually issue you the funds if it's a cash payout, like it's a tender offer for cash instead of for stock. The money will just appear in your account. You generally don't have to execute a sale at all. And when I say generally, I can't think of a time when you didn't have to execute a sale on that, so, or I didn't have to. But yeah, So back to this question here, the Keith X. The main portions of my portfolio are VTI and VOO. Other ETFs that I hold, or I have a little bit in LIT and a little bit in BATT. I'm a little bit heavier in LIT because one of the main holdings in there is Albemarle. So I've been doing some research on behalf of someone who's in my Patreon group right here, because talking about the sodium-ion batteries and who are some major sodium producers and all that. Luckily for us, if you are invested in LIT or BATT, you are already fairly well set up for to be involved in increased sodium mining. There's going to be more opportunities there. So I don't know who really does a lot of chloride production right now, which a byproduct of chloride production is going to be sodium, of course. And there are a lot of other industries that are going to produce sodium as well, that already exist, already have this as a waste product, are already producing other products with it. That's probably going to be redirected towards batteries. Bram made the good point that these sodium batteries are heavier than than a lithium battery is, but it's only somewhere between 320 and 380 pounds for a vehicle, which if you're not in a performance car, it doesn't matter, right? If you're in a truck or you're in a daily driver, the difference in 320 to 380 pounds is one overweight friend in the car, right? It doesn't make a ton of difference in terms of your performance. And I don't think it'll make a ton of difference for people unless you're in a sports car. So, and of course, stationary storage is probably going to be more directed towards sodium ion batteries, and we are just on the cusp of really this stationary energy storage revolution that's happening for like grid level storage, and that's coming. There's already huge projects here in the U.S. There's huge projects in California, huge projects in Australia. There's like 3 really big projects for energy storage using batteries in like grid level energy storage in Australia, and here in California, a couple in Texas, I think in Tennessee, and one in Georgia as well. There are some experiments going on right now. So, oh man, you are bringing up some questions. Sean, you're bringing up some questions from like 2020. Let me get to those here in just a moment here. So Brian Lee says, hi, Jason. Thank you for talking about SoFi today. I hold lots of SoFi, even though I've sold half of my holding. Still like the company, but losing some confidence. Would love to buy it back. So I've never lost confidence in SoFi because there has been no deterioration in the performance of the company. If anything, the performance of the company has grown more and more impressive as the prices decline. I think it mostly has to do with macroeconomic conditions and people repositioning money for more of a sure thing. And like I can't, as a licensed professional, man, I can't guarantee you anything, right? It would be unethical for me to do that and really just dishonest, right? But in terms of taking a business now that has the potential for long-term compound annual growth that's likely to beat the overall market, right? My return expectations for the S&P 500 are roughly 7.2 to 8.2% over the next decade or so. I think that SoFi will have a really good year this year and next, and probably drop down to about 10% compound annual growth in terms of the stock, unless company fundamentals far blow away what I think is going to happen. But look, there's a couple of things that are really working well for SoFi right now. They're really low cost, their customer acquisition cost in comparison to other financials. The fact that they have been just raking in money in terms of deposits from other financial institutions. Some of that is being driven, of course, by their 3.7% APY on their high yield savings account. But a lot of that is just driven by the fact that folks are not very loyal to a financial institution. With a financial institution, because the relationship is sticky. Once you get involved, it's just a pain to move, right? It's just a pain to move things. SoFi has really worked on making it easier to move your financial relationships. And they are not targeting. So banks target old people. You want to get people to move based on a quarter point difference in CDs. You want that guy who's over 60, who has $100,000 to $500,000 in deposit. You want him to put it in the bank account, leave it in the bank account if you're a banker. You don't even want to sell them financial products. You really want to leave that $500,000 in a bank and get them to buy a mortgage or something like that, right? If that money leaves, let's say like Wells Fargo, the bank branch, but the branch, the guy who does investments in the branch from Wells Fargo Financial, it's actually 2 separate companies. Wells Fargo Financial is a wholly owned subsidiary of Wells Fargo, but they are not FDIC insured. Wells Fargo is FDIC insured. That's the investment branch. If that money leaves the regular bank branch and goes to that Wells Fargo Financial guy, that money actually is removed from the deposit base of Wells Fargo and actually hurts the bank manager's bottom line in terms of deposit growth, right? Because they're not focused on the entire ecosystem. You have really competing interests within the company. And this has been the big problem with all banks that have a sort of that legacy bank idea, and that are on these COBOL mainframe systems that were designed in the 1960s and 70s. They're not nimble enough to keep up. They have competing interests within their own bank that interfere with the way they can do business, and it makes their customer acquisition cost like really, really high. I think that for a bank, the average acquisition cost for a lending product is something like $1,600, right? The average, and that's not for the entire financial industry, that's just for banks, but the average acquisition cost for inorganic for the industry as a whole is like $1,200. It's $248 as of last year for SoFi. I was not able to find any current numbers on what current acquisition costs are going to be for this year, but it's going to be more because SoFi is spending more on advertising, but they're doing it in the best sort of bang for your buck kind of deal. There, it's a lot of social media advertising, and yeah, it's a lot of social media advertising. I'm seeing it everywhere, and I'm not in their demographic. SoFi has taken over TikTok. You will see if you look at anything financial on TikTok, you are going to see a SoFi ad that day. Okay. And as you see those SoFi ads increase, you're looking at, and why are they looking to grab these customers? These customers don't have any money, not today, but there is a giant transfer of wealth going on between baby boomers. Money's going to millennials, money's going to Gen Z. It's kind of skipping over Gen X a little bit. A lot of people in the Gen X timeframe, because of the way the economy worked, they're not going to inherit as much money or get that wealth transfer as it is going to be for Gen Z. Gen Z is a much smaller generation than millennials. It's a much smaller generation than Generation X, a vastly smaller generation than baby boomers. That's going to create a labor crunch. They're going to be higher earners. They're going to be inheriting wealth. They're going to be moving their way up the value chain in terms of a customer. They're being advertised to now. They can get you to open up a high yield savings account. They can sell you 4 other products. That's kind of how it works. Once you have 4 or 5 products in their system, you just aren't likely to leave. And banking behavior for younger people is very different, even for folks of my generation. Most people in my generation still go to the bank. I don't go to the bank. I have to go to the bank once a month because there is somebody who works for me who doesn't have a bank account and just insists on being paid cash. And I'm really doing it as a favor for them. But otherwise, I would never go to the bank. And before this person started working for me, I hadn't been to the bank in years, right? And I'm not the only one, but there are many people who are younger than I am who've never, ever been inside a bank. They've only done their banking online. They've only done their banking through apps. And I don't believe that is changing. That is gone. If you are in face-to-face in-store banking employee, your opportunities for advancement are severely limited because the need for you is going away. This is a white-collar job that is going away. Likely, if you lose your job in one bank branch location and you weren't a top performer, you're not getting back in one. Okay, unless you were a top performer. All right, that's one of my opinions. If you work in a bank, let me see here. Oh man, so let's talk about Microvast and Proterra. And hold on, these are like 2020 questions, Sean. Haven't thought about this in a while. Yeah. So these companies have been around for a while, but like I said, anything with a stock price this low, with earnings per share this low, I don't believe they've ever been profitable. Yeah, they've never been profitable since 2008. I've looked into this company a couple of times. I haven't found anything that really makes them stand out. Trading volume is healthy enough to say that this is a real market and this is a real value. And I think this is closer to their true value since they've never shown any profits. And I think that rather than caving to the temptation of buying a lot of stock for a little bit, which look, I'm guilty of doing this too. This is exactly what I did with NEO. Is I saw an opportunity, bought several thousands of shares of NEO at like $1.68. No, it was $1.80 or $1.68. I don't know. Ended up selling it at a 10x, but I could have sold it at like $73 a share. Ended up getting out between 22 and 18. So let's call it 10x, right? Based on all of my shares. But yeah, that's when I got out of NEO at that point. Largely reduce the risk on my balance sheet, realize those gains, and reallocate somewhere else. Microvast and the whole lithium-ion battery chain, because this industry is so small and it's going to explode and it's going to contract and there's going to be consolidation. I don't think I would take a chance on any one company in this industry. I'd rather hold this through an ETF, through a concentrated ETF on battery technology. So in very soon, these battery-focused ETFs are going to not radically, but they're going to announce a change. They're going to say we're no longer the lithium-ion battery chain ETF. We're a battery ETF because they know that sodium is coming. if what is being commercially produced right now at scale by CATL has 160 watt hours per kilogram gravimetric energy density, which is almost exactly the same as BYD's Blade battery, the lithium iron phosphate battery, and lithium is at roughly $80,000 per metric ton, and sodium is at $3,000 per metric ton. It's a no-brainer just based on economics alone, and all of the other chemistry is similar, but really dissimilar in one way. Recycling sodium ion batteries is going to be a lot less expensive and a lot less toxic. So that is absolutely what's going to happen. So I definitely wouldn't take that sort of chance on that. So, and there's a lot of EV makers that I'm not taking huge chances on. The only thing I've taken huge chances on has been Tesla. Okay. But now that every other major manufacturer has recognized that Tesla's manufacturing margins on their vehicle, when you just look at their manufacturing margin versus what they sell it for, not counting all the other expenses they have, and all of the other expenses they have that aren't related to just selling the car, they have better margins than anyone else in the business. And this is the reason that every company on the planet has announced that they are making a switch to EVs. Doesn't mean they would keep selling gasoline vehicles if it weren't possible to make more money by selling electric vehicles. That's the only reason they're doing it, is they can make more money. Right? It has nothing to do with saving the planet, has nothing to do with a carbon neutral future. It has to do with making money. And this is the best way to encourage this sort of change. Like, I want to break the monopoly and cycle of energy wars that we have had for the last 150 years. This is what I want to break. Using and basically using a combination of renewable sources like solar, wind, geothermal, and hundreds of other sources of power that are out there. There's a lot of folks out there that think that in a couple of decades we'll be 100% on renewable energy. A lot of industry specialists in oil and gas think that a couple decades from now, all of our energy is going to be derived from renewable sources. There's still going to be an oil industry out there, but the reality is a lot of that oil industry is going to be from artificially created oil as well. We're already using microalgae to make oil substitutes at this point. It's too expensive for that to be commercially viable. But that process, once we know it's possible to do so, that process is going to be continually improved. So, yeah. You see here. Speaking of stationary storage, Fluence Energy looks like it's a major player. Lucky enough to have bought in 11. They have projects around the world and are part owned by Siemens. Okay. Fluence Energy is one that I don't think somebody on a live stream asked me to take a look at Fluence Energy a while ago. Like I said, he's another one of these companies that are showing nothing in the way of earnings right now. Declining revenues the last couple of quarters, but over the last couple of years, they've grown fairly significantly. Revenues at $1.2 billion, just $104 million in losses. Actually, not so bad. I would need to do a little bit more research on this company. I just don't know enough about it, so I don't want to say anything negative about that. But market cap is $3.81 billion, healthy volume at 1.2 million shares. Anything else on that? Not that I know of. 52-week ranges from $4.96 to $27. Yeah, well, congratulations. If you doubled your money in a year, that is amazing. Taking a look at a lot of these companies, though, be very careful about a lot of these companies, because even the ones that are backed by big money are going to fail. Like, I think that Rivian, who was at one time backed by Ford, Ford had a large stake in the company. I think that they are in danger of failing. And maybe not anytime soon, but their ability to go to the well and do secondary offerings to raise money for nothing, I think that's a big warning sign for them. They're going to have to borrow money now or issue bonds. I think they're going to have a hard time selling bonds because, I mean, what kind of rate, if the risk-free rate is 4.5 and it's going to be 5% by the middle of the year, what kind of rate would I need on a bond where a company has made under 100,000 vehicles? Sure, they've got $7 billion in cash, $8 billion in cash, but they made under $100,000 in vehicles. They missed all of their production targets. They just shuffled around all of the management. A lot of people left. the fact is their stock price is so low that going back and doing a secondary offering doesn't look attractive to the market right now. You no longer have the ability, like Tesla did, to do zero coupon or really low coupon convertible bonds, and issuing a regular bond. You're probably going to have a coupon rate of 8 or 9% on that, right? So what? How are they going to raise money to expand operations? How are they going to do that? Okay, because they need that $8 billion to fund their cash burn until they can sell enough vehicles and also to increase production. But once they hit that limit, where's the money for the next product come from? So we're already looking at the Ford F-150, and these are different class vehicles, of course. But the Ford Lightning F-150, they're on about 150,000 unit run this year. They delivered like 22,000 units across the country. They're going to deliver somewhere between 94 and 110,000 vehicles by the end of the year is what they're predicting. Then they're going to introduce an electric Ford Ranger at some point. They're not talking about it, but that's got to be on somewhere. And they've been in terms of full size trucks, they sell roughly 600,000 F-150s a year. The Ford Lightning F-150 was just named like vehicle of the year or something like that. It cannot do everything that a truck can do, but Ford knows the dirty secret of truck owners is that 90% of truck owners, people who own a truck, never do truck stuff. They never take a trailer and haul it for 1,000 miles. They never load it down with a load of bricks and drive 500 miles with it or something like that. They don't do that. It's basically a status symbol. It's basically a social signal or social indicator of what class of people that you belong to if you own a truck. You don't actually tow horses to rodeos. And there are people that do this, but it's way less than 10% of the people who own a truck actually use it for work purposes or use it to haul things or use it for the things that, the people that I grew up with use it for, to trailer horses around, use it to trailer cattle around, use it to move livestock, use it to move dirt, use it to move rocks, use it to move construction materials. Those are the people that I grew up with. In the city where I live now, like greater than 90% of the people you don't use it at all. And the ones that are using it for truck purposes are basically using it to go to the desert 2 or 3 times a year or to tow a boat down to the ramp. That's it. I can use a Ford F-150 and tow a 7,500 pound boat to the boat ramp and back. And I don't care that I went from 230 miles in range to 150 miles in range because I'm not using that 150 miles of range anyway to go 20 miles to the boat ramp. That's it. Or 10 miles to the boat ramp. That's it. So Ford knows this, and they know this is why this is going to be a great seller. And it really has some interesting improvements in terms of storage and power usage. And it's just a great truck, but you can't use it to tow things long distance. The range drop on it is really significant, but they know that most people, not just most people, the vast, vast majority of people aren't doing that. So you're looking at all of these companies who make full-size pickup trucks are going to have a version of it that's electric. And pretty soon, the electric version is going to be vastly outselling the gasoline versions. I don't expect there to be a huge impact on the diesel versions of these trucks, largely because the people that are willing to spend the $100,000, $150,000 on those versions of the trucks have very specific needs for those, and those needs aren't going to change or be addressed by the introduction of a battery electric, pickup truck anytime soon, right? That's not, and the market is much smaller for those. What they're really looking to produce is the gas-powered Ford F-150, produce a battery electric version of that. They know it's going to sell well, and I would suspect that smaller trucks are coming next. There was a lot of excitement when Nikola came out with their artistic rendering of the Badger, right? They never came out with a truck. They came out with an artistic rendering of it. It was essentially the most expensive piece of artwork on the planet. Roughly about $12 billion worth of value is probably attributed to those, to rolling a truck downhill and a few digital images of the Nikola Badger that never existed. But there was a lot of excitement for that Nikola Badger because it was supposed to be a sort of a Toyota Tacoma-like competitor. I wouldn't be surprised if that before Toyota goes anywhere near a full-size electric truck, that they really hammer that Toyota market with an electric option. And that I expect that the price would be high on that. I think that Toyota probably wouldn't compromise on performance like Ford has done a little bit with the F-150. I don't think that. So yeah. But anyway, let me see here. Brian Lee says, thank you, Jason. I have the same thinking on SoFi Future as your comment. I'm the kind of generation that's switching, going from the bank monthly using bank app daily. I can see the huge benefit of the banking future. Long holding SoFi for sure, and would like to increase my holding when the market regains. So I'd actually say that, like, I'm adding SoFi, and I can do that because it's no longer 10% of my overall net worth because it's lost so much value. But I'm actually adding SoFi at this point just because the prices are so low at this point and the company has grown so well. So I'm still adding at this point, knowing that we're probably in for more market volatility. I will say that this week for me has been the most positive sign about the market. And yeah, been absolutely the best sign about the market. And if we are up by the end of this week, I'm predicting that for the full year, we're probably going to see a close to a 20% gain for 2023 as a full year, which I think is going to be great. It's going to be a rising tide that lifts all boats, though, and there's going to be you have to really do the calculation to see how much of the gain in the stock is due to the market as a whole rising and how much of it is due to security selection. And I don't think that we're going to see much gain in a lot of stocks beyond the gains in the market, but I do think that SoFi is one that will probably outperform the market this year. So Kevin X says, all right, Jason, I have to get back to work. We'll watch this later. Thank you. You know what, buddy? I'm almost finished anyway. Happy to answer questions for as long as I have questions, but we're coming up on the hour that I have allocated. I don't actually have anything, a call or anything right behind this like I normally do, so I can stay on a little bit longer. So another company that I love is Neo, made big, sold at 57, not now owning. I think the highest may have been like 68 to 73. I don't remember. I didn't sell any then, and I wish I did. Would love to buy back in, but many negative comments on it. What do you think? So I've addressed Neo a couple of times. I don't own Neo stock anymore. I got out between 22 and 18, not because they were doing anything terribly wrong. I realize that it's mostly the macroeconomic environment that's really affecting Neo. A lot of it had to do with risk concentration. I just had too much money in Chinese stocks. I generally don't like to have more than 2 or 3. And I don't like to have that much money because I've been burned so many times by companies reporting false numbers and things like that. And there's a lower degree of trust. I think that when you're looking at something like an Alibaba, that lower degree of trust doesn't really exist. Like I trust them as much as I would trust any S&P 500 company, which is not that much, but enough that I don't think they're going to do anything that like an Amazon wouldn't do that's shady, right? The difference with Amazon is that we have investors here in the U.S. have recourse, right? If something goes wrong, they're going to be fined. If something goes wrong in the liquidation, I might make a little bit of my money back, probably not, but maybe a little bit. And I know that the government here can't arbitrarily stop Amazon from doing business. That is not the case in China, right? And we don't have any recourse here for anything that goes on shenanigan-wise with Alibaba. Now, so far, they've been really good at following our laws and regulations and that sort of thing. It doesn't mean they'll do that forever. There's a lot of geopolitical risk when it comes to investing in China that has nothing to do with the health of the company. Neo doesn't escape that, right? And even more so, they don't escape it because they're so deeply in bed with local governments, not necessarily the CCP directly. And I don't even like calling them the CCP. Like, you're not a communist country if you've got a stock market. I'm sorry. You are not a communist country. You aren't a communist party if you're the one that introduced the stock market. Okay. So I just wish people would be honest about what their name is. State capitalism is probably a better word for this. Some people call it like a fascist country. I don't think that's correct either. I think we need to start sort of basically there needs to be a renaissance in the phrase state capitalism. The United States practices it to a degree as well. It's just different, done differently than China is. So, but for a number of different reasons. Number one, the larger companies in China started producing electric vehicles in volume. NIO is a luxury brand. They really haven't worked their way down that value chain to any great degree. And BYD is absolutely kicking their butts. How much negotiating power are they going to have with component producers when they don't own their own factories? They have this onerous per vehicle fee that they have to pay to JAC Motors. And they're really a car design company wrapped in a branding exercise. Not terribly different than, say, Apple is. Apple is really a software and phone design company. They don't produce anything that they make, and they assemble it from pieces that are made elsewhere. So how much different are they than Apple? Not that much different. But in terms of their cost wise, they've set themselves up for sort of reduced margins uh, if they go down into that lower market strata, which they're going to need to do that to really grow at the pace that we think they need to grow to justify the money that we put into it. So I kind of switched my investment over to Xpeng at a really opportune time too. Like I bought in at like 18.20 a share, 18, or I'm sorry, sold out at 22 to 18 a share, ended up sitting on Xpeng for quite some time. I was able to repurchase or purchase more stock a little bit at 6, but not a ton more. But it kind of lowered my average. But I'm still down in Xpeng as well. It's just down. It's one of those stocks that I really don't look at this point right now. Not the stock price, but I'm following the stock right away. Well, but also Neo has spread out with so low production. Rather than concentrating on selling the vehicles that they have now, they keep making new models as well. I keep getting excited about the new model and then realizing that there's not much really that differentiates it from all of the other competition that's coming out. I'm telling you guys, I've been talking about BYD forever, and people message me, people comment, people tell me I don't like BYD's cars; they're ugly. Just doesn't matter, man. It's kind of like with the Cybertruck. It doesn't matter if I think it's ugly. There's gonna be lots of people that are satisfied with it just the way that it is because it hits the right design and price points, right? So I got burned every time I owned Xpeng. Yeah. So I'm just buy and hold. So basically, I've been burning for quite some time for the last year and a half, right? And that's just the luck of the draw. Sometimes you don't really get a choice in that. But long-term investor. So I've got kind of 8 years left on my 10-year minimum window for this, or 9 years, or no, 7 years left on my 10-year. Wait, we're in 2023 now. So I've got roughly 7 years left on my window here for owning this. So we'll see how I feel 10 years from now. All right, guys, good talk today. It is over an hour. I'm looking to get off this live stream today and take care of some business. Made an unscheduled stop at Discount Tire today. Something really interesting happened today when I got a flat tire. Somebody within 5 minutes of being pulled over the road, the San Diego's highway road assistants stopped and helped me change that tire and probably saved me some from some busted knuckles and dirty clothes as they had, stuff to keep me from getting dirty and things like that, which I didn't have in the car. And just goes to show you that every once in a blue moon, there is an example of your tax dollars being spent wisely. I don't normally say that. I am not a huge fan of government. I'm not a huge fan of government regulation. In a lot of cases, not all cases, but in this case, it's one of those things the government spent money on that I definitely approve of. And so thank you very much for San Diego's Highway Assistance Program. It went a long way towards not pissing me off for the rest of the day. Anyway, I will see you guys. Actually, I will not see you on Monday. I do have a couple of doctor's appointments that day, so I will not be doing a live stream on Monday. I'll definitely be back on Thursday, though. I'll try to get something else out. There's some economic news coming out this week and a few other things that I want to talk about. So I'll have a video out for sure on Monday. I just won't be doing a live stream. All right, guys, thank you very much and have a nice day.